Closing out Q1 2022, and what a quarter it's been. From New York City this morning, good morning, good morning. Futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, discussing new sanctions on Russia.
We are continuing to look at options to expand and deepen our sanctions, and I anticipate that we would probably have more for you on that in the coming days.
Ramping up the pressure abroad and looking to alleviate the pressure at home. Bloomberg reporting the White House is considering a massive release of crude from its reserves to combat inflation and surging gasoline prices. Crude trading sharply lower on the news. Investors now looking ahead to 1:30 Eastern Time, with President Biden preparing to deliver remarks detailing his administration's plans on how to address energy prices. Team coverage starts right now with Bloomberg's Maria Tadeo from Budapest and Emily Wilkins down in D.C. So, Emily, let's start with you. This Bloomberg story rocking this market, for crude at least, this morning. Run us through the details.
So we're expecting to hear from the Biden administration to announce today that they're going to start releasing roughly 1 million barrels of oil a day from U.S. strategic reserves. Now, we've seen other releases in the last year, but this one's expected to be much bigger, potentially 180 million barrels of oil when all is said and done. This is really directed as gas prices have continued to gone up. The Biden administration initially expected them to go down this year. That hasn't happened, and now Americans are facing pressure at the pump, and Democrats are also facing pressure to really address this key issue as Americans are struggling with inflation, and they face an election that is not expected to go their way this November.
Maria, that's the United States. Europe, as you know, has its own problems.
Yeah, it does. And Jonathan, when it comes to the sanctions, are we going to see anything that tackles the energy market? That very, very reliant relationship between Russia and, of course, the European Union, we're probably not going to see it. I think, if anything, the debate here is not do we ban it or veto it or not use Russian gas this winter. The question is, how do we pay it? That is a real debate happening in Europe. And today we heard from the Italian Prime Minister, Mario Draghi, very clearly signaling that he had a conversation with Vladimir Putin. And in that conversation, the Russian president repeated that European companies would be able to pay in euros. There would be no need to pay in rubles. That was the initial demand. It does seem that the Russians are backing away from that. And again, another warning from the Europeans that anything that looks like breach of sanctions and breach of contract would be incredibly problematic for them.
Maria, Emily just went over the political pressure from the electorate the administration was under, the president specifically, ahead of the midterms. In Europe, there are a series of elections starting this weekend, France included, and where you are. Run us through the kind of pressure they're under.
Well, we have the Hungarian elections happening here. Of course, there's Viktor Orban, who's running now for a fourth term. Now, this was an election that was supposed to be very political, about family values, Christian values, defending Hungary for the Hungarian people. But of course, the war in Ukraine has overshadowed all of this. And if anything, what you see now is that Orban, he is polling well, because he says we're not going to veto Russian energy. We are not going to go for super strong sanctions either, because we need to watch out for our own economy. Our interest is to protect our economy. It's not the Ukrainian people that I have a duty with, which of course is a very blunt message, but essentially that is the gist of this campaign. When you look at the French election that's happening next week, of course, and then you have the final result in the final week of April, it is complicated for Emmanuel Macron. We are seeing that bills are rocketing across Europe. We see it everywhere, and every day we see finance ministers, one right after the other, hinting and saying we're going to need more measures to try to calm down inflation. At this point, it is a very real problem away from all of the political issues that we're facing. This is just a spending problem for Europeans that are definitely seeing their bills are all going up.
Maria, thank you. Maria Tadeo and Emily Wilkins on the political situation and the prospect of a monster reserve release from this administration maybe later today. We could be seeing anything up to 180 million barrels of oil released, and crude is down around about 5 or 6% through much of this morning. Joining us now to discuss is BlackRock's Jim Keenan, Nuveen's Rudnick, and Julie Biel of Kayne Anderson Rudnick. Julie, first to you. This quarter has been amazing, and at times amazing for all the wrong reasons. Talk to me about how energy and the moves in crude this quarter alone has changed your view, perhaps, on the year ahead.
Well, I think it's now made it much more difficult for things to work out for the Fed in terms of architecting a soft landing. And I think now they're been to a much smaller corner in terms of being able to execute a more gradual transition. We now are talking clearly about 50 basis increases. If you just asked me in January if that were possible, I would have said no, because I think Powell was really behind the curve on it. But now he's regularly talking about 50 basis point increases. And the White House, too, is well aware that becoming an increasingly difficult position for a Democrat, where it's very hard, really, for administration to do much on the nation. And so it's having to these big, bold gestures, like releasing reserves. I don't think it's going to have a huge impact on oil prices. It does really impact the politics.
Julie, just a little bit of a technical connection problem with the audio. We're going to try and re-establish that. Jim Keenan, I know you wanted to jump in, so you can now, sir. Your thoughts?
Yeah, I would say I wouldn't necessarily use the word amazing. I would say highly complex. I mean, if you think about how we ended last year, we already started to see a tight labor market. The energy markets, were rebounding dramatically just with regards to the restart of the economy and the demand side of the equation. When you think about what's gone on over the last month, we've exaggerated or accelerated some of the trends that have gone in, and so the energy market in general is incredibly tight relative to the underinvestment that we've seen for the last 5 or 6 years. And you have an environment where there is, I would call it, more discipline with regards to bringing on supply. And it's also difficult to bring on supply because of, the labor issues, the scarcity of some of the resource and materials needed to kind of to really get the oil markets and the gas markets up. So I think that pushes the Fed into a much more complex scenario with regards to the pressures that they're seeing on inflation. And their limitations on how they're going to be able to ease that. And so certainly, I think you're going to see the Fed, hold to this hawkish tone. You're seeing the consumer sentiment come down pretty quickly just with regards to the uncertainty of the tax that they're feeling. And I think that's going to create a lot of volatility in the overall market. I don't necessarily think it changes the long term, but this transition from where we were in the last couple of years in the restart to transition to a more normalized economy coming out of all the complexities of the pandemic and the supply chain issues is going to have a lot of volatility around the overall economy and the corresponding policy.
That transition has come with higher prices. Brian, Nick, just to give you the opportunity to respond to the story we've started with this morning. We've seen this movie a few times over the last 6 months. They have a crude reserve release, crude gaps lower, then it gaps higher again. We've seen it a couple of times. Any reason to believe the plan that we've outlined in our story this morning wouldn't just end up in the same place, with crude gapping lower a little bit and then back to where you were before?
No, in fact, I think you were right to focus on the political dimension here. I think there's clearly a political imperative with the elections coming up in November to seen as doing something to try to get prices back down. But I think absent a durable, sustainable increase in supply or some resolution to the conflict that results in lowering sanctions, you're not going to see a fall in the oil price to the levels that we saw in the beginning of February, which are already elevated. And I don't see either one of those things happening. What this has done is thrown a lot of confusion, I think, into the economic outlook and specifically into the job that policymakers have ahead of them, because what this does is effectively act as a tax on consumers. I mean, imagine seeing a 1 month increase in German inflation of 2.5%. There were entire years where they didn't hit 2.5% on an annualized basis, and now we're seeing it in 1 month. So that makes it extremely difficult for policymakers to know what to do, because if this is effectively a consumption tax and will detract from other things that people normally spend their money on, then it's not clear that the right move is to raise interest rates, unless you see inflation expectations also becoming entrenched at much higher levels. And in that case, the Fed maybe, and the ECB as well, may think they have to respond to this with higher rates. So it does throw a lot of confusion into what was already a pretty complex
Things
situation.
have changed so much. And Jim Keenan, to Brian's point, if this plays out in Europe, as some people think, we face the prospect of interest rates going back through zero. Now, I know that sounds ridiculous, but 2014 was the first time they went into negative territory over at the ECB. They've stayed there for 8 years. Now, Jim, I wonder how that would transform global fixed income if you could have a positive nominal rate out of the ECB, how it would transform the European bond market and what it would mean for that matter for treasuries and for credit too.
Yeah, and it goes back to the point with regards to complexity. I mean, the economy is coming out of a pandemic, and this restart, obviously, for the last 12 months, coming into this year, I think there was a lot of certainty in the overall market. There was certainty with regards to the speed of the recovery. As you enter this next phase here in this regime, there is a lot of complexity, and I think there's going to be a lot of inequality with regards to what that means with different regions, but also with regards to sectors. And specific to Europe, obviously they're more exposed to the issues of the Ukrainian-Russian conflict and what that means for gas prices there. So the inflationary pressures that they're feeling, the health of the consumers in a different spot than the United States. And so I think that's a pretty acute issue right now in the short term with regards to the potential with regard, even a recessionary risk in the next kind of 12 to 24 months. I think long term, we're all still going to deal with, as we come through this, we still have to deal with significant aggregate debt burdens that now sit on government balance sheets. And so those, I think, are going to be headwinds to longer term growth and keep the long end of the curve, I would say, fairly anchored within the range. And so I do think you're starting to see, you've seen it already with regards to the flatness of the yield curves globally, and even some inversion because of those longer term issues as we have to deal with.
Jim Keenan sticking with us alongside Brian Nick. We'll re-establish that connection with Judy Biel. She'll be back in just a moment. Some stocks on the move ahead of the open in Biel, 20 minutes away. Here's Abby.
John, well, sticking with this lead story that you all are discussing, or the idea that the Biden administration is weighing the possibility of a big daily release from U.S. reserves. Not surprisingly, oil down, as you know, down around $102 per barrel for WTI crude. The energy complex really getting hit. Big oil, Chevron down 1.4%. Schlumberger Oil Services down 1.6%. Murphy Oil, a domestic producer in the pre-market lows, down 5%, right now down 2%. Not surprisingly, what's benefiting the travel trade? American Airlines right now, John, up 1.2%. We've seen this dynamic before. You make a good point on back and forth. It'll be interesting to see how it ends up.
Abby, thank you. One to watch ahead of the open in Biel. Here's another one. Ed Ludlow joins us now from the West Coast. Ed, run me through this. Another rocket launch. Right. Now, can you tell me this? When can I stop paying attention to this and just treat this as a plane taking off at JFK heading to Heathrow?
Yeah, it's a really good question, John. For Blue Origin, which is the space startup founded by Jeff Bezos, we're not quite there yet. This isn't quite routine as it is with SpaceX. This is the fourth time that Blue Origin will carry human beings into space, quote unquote, beyond the Kármán line, 62 miles above the Earth, which is the internationally regarded boundary of space. We don't know how much these folks are paying. There are 6 crew members on board. We're on a brief hold right now. If you look on the left-hand side of your screen, you see that H 11 minutes. It basically could be any number of factors, right? It could be the weather. There are a number of teams that are prepping this launch, and they're all trying to work in synchronicity and catch up with each other. And a hold is very normal. But I love that question, John, because the reason I'm here in San Francisco tracking this, we at Bloomberg track this, is there's big money behind it, right? Jeff Bezos has put $1 billion a year into this company. We have no idea how much those folks on your screen are paying. But on the left-hand side, Gary Lai, he is the sub, John. He's been subbed in for Pete Davidson, who was, you know Pete Davidson, right, John? He was going to fly on this mission, sure, but he pulled out. And Gary Lai, who's a very senior executive at Blue Origin, is taking his place. So of the notable milestones that we're looking at this mission, it's a good one for him because he literally designed this entire launch system. So for him as an executive in the industry, this is kind of a full circle moment.
Ed, does anyone feel uncomfortable about this? You know, I've started this segment this morning talking about war in Ukraine, the cost of energy prices. And here are 6 people on a vanity mission to float around in space for a little bit and come back down to Earth.
Yeah, John, 2 things. The war in Ukraine and Russia has put a real spotlight on the commercial space industry. For Blue Origin in particular, because they're not just doing this. Their product is not only sending rich people into space for a few minutes. They also hope to be a manufacturer of rocket engines. And for a long time, the United States has relied on the Soyuz rocket, built, of course, in Russia. The Russians have withheld access to those rocket engines because of sanctions. But the other part of it, and I do like your question, John, but the other part of it is that with every rocket launch, no matter who's operating it, there is risk. And when there's human beings involved, there is risk. And while they're supremely confident in the safety of this system, we always watch because there's risk because of the propellants used, in Blue Origin's case, hydrogen and oxygen to power the BE-3PM engines. And so you always have to pay attention just for that reason.
Well, Ed, I know you're paying attention, and you'll be back, no doubt, later this hour to keep us up to speed as well. Ed Ludlow there from the West Coast. Coming up, Western allies seeing little reason to believe Putin is de-escalating.
If the Russians were really serious about de-escalating and the way they spun this yesterday, that they're trying to take the pressure off, well, then send them home. And that's not what they're doing, at least not yet.
The conflict on the ground continues for the Federal Reserve. They're trying to shake this off, looking ahead potentially to a 50 basis point rate hike. That's next.
I'm open to it. I think the question, and we'll make this decision when we get to the meeting in May, is how strong does the economy still look in terms of its ability to take rate increases, and how high is inflation persisting? So I'm looking at both of those, and we'll make our call in May.
Everybody else is making that call for them. Seemingly 50 basis points in May, then again in June. Mike Ferro, JP Morgan on board with that now. Just getting a headline across the Bloomberg from Vladimir Putin saying the following: we'll continue supplying gas at set volumes and prices. As for prices, let's talk about currency and what have we paid in. Putin saying Russia to halt gas contracts if buyers don't pay in rubles. That just crossed in moments ago. Mike McKee joins us now. Mike, this is a tricky moment for central bankers, managing what's happening with energy and trying to do something as well about inflation with rates.
Yeah, the whole Russia gas situation raises the question of an enormous jump in inflation in Europe. And what does the ECB do? They can't turn on the gas. So it's tough for them. It's also tough for the Fed here in the United States. We got a reminder this morning of why they're raising rates. Take a look at the PCE index. That's the Fed's favorite inflation measure, all the way over on the right-hand side there. Notice how it is now up to 6.4% on a year-over-year basis. The chart shows you that every time the Fed has had to bring inflation down, they move the Fed funds rate above that PCE level. Do we get a 6% Fed funds rate out of this? Well, we're going to get maybe 50 basis points, as John was saying a few minutes ago, because the case for 50 has been pretty much joined by everybody. Bullard and Waller and Mester have said they're on board. And Jay Powell started it off by saying he's willing to go 50 if necessary. And the others who are voting members of the Open Market Committee have pretty much agreed that they're willing to do it if necessary. And today's numbers sort of remind us that they may be. And here's something else that's an interesting reminder. We did see compensation go up this month, wages and salaries 0.8 in the month of February. But even with all of the pay gains that people have been getting, you can see the employees' share of corporate profits. And corporate profits were up 35% last year, the highest since 1950. But the employees' share has now dropped down below where it was in 2019, which tells you at this point there's not a wage price spiral going.
Mike McKee, thank you. I know you've got to run to get a plane to go down to D.C. and bring us payrolls tomorrow, so, buddy, you get off. Thank you very much, Mike McKee. Jim Keenan, Brian Nick, Julie Biel back with us. Julie, to come to you. 50 basis points now seems to be the consensus on the street for the next meeting and the meeting after that. And Citi's Andrew Hollenhorst thinks they go again at 50 basis points and again at 50 basis points. Where are you now, Julie? This just feels like a fight on Wall Street between who can out-hawk each other.
Yeah, I mean, I think everyone was a little bit slow to catch on to the concept that inflation was going to be quite durable. And I think everyone now is going to respond. And I think the bigger question is, does the Fed also overreact and create a much, much more painful hit to demand than is expected? I think there's a real risk that the Fed maintains its stance a little bit behind inflation, and we have a period where demand takes a real hit and inflation is still high. And that's painful, I think, and that is really problematic for voters to really think about.
Jim Keenan, what's your assessment of market pricing on Fed action this year?
Yeah, so I mean, we've talked about the complexity. At the end of the day, I think the Fed will try to be data dependent. I think they do have to move pretty aggressively to try to reduce some of those inflation expectations right now. But I think as the market goes, you have to kind of look through what is the easing of some of these supply constraints that you've seen come out of the pandemic. And we don't know the answer to that, right? You know, obviously we talked about Ukraine and Russia. All these things are going to be fairly volatile over the course of the year. And I think the Fed is going to take its tone, in the back half of the year based off of that. The market pricing, though, is, I think, going to be incredibly volatile. Obviously, that inflationary pressures has a huge difference depending on what sector and who's losing and who's winning off of that. But the markets, from a pricing standpoint, are going to continue to debate, in almost a tug of war between every inflationary data point. We just discussed PCE, what they think that the Fed should do, other central banks could do. And then, so I think the risk premiums in the market are going to be pretty volatile. What you've seen in the first quarter already, I think that continues throughout the year.
Rudnick, I want to share this quote from Deutsche Bank with you. If you believe that asset markets have already largely absorbed the current rate structure and are now priced for a 3% terminal rate, there are good arguments to suggest the terminal rate can go higher still until such time as financial conditions tighten materially. Would you agree with that statement, Brian?
That's the thing that's concerning about seeing, seemingly every week another rate hike get priced in and the equity market continues to rise, credit spreads continue to compress. Yes, we have the inverted yield curve now, especially the short-term yield curve is showing an inversion and the Fed's going to have to be cutting by the end of next year. But I think there's something to this, that if the Fed really wants to tighten financial conditions because they see themselves as basically too loose right now, fostering higher inflation, their forecast for core PCE this year is 4%, which is double their target. They're going to need to look at how the markets are responding, look at how financial conditions are tightening, or in this case are not tightening, and maybe have to go further. And this is why I think you sort of lose a sense of a limiting principle here. How high does the Fed have to hike? It has to hike until there's some kind of pain that's felt, unless and until inflation starts to come down on its own. So one of the encouraging things about the data this morning was PCE inflation for durable goods, which remember was basically the source of all the inflation from last year, was 0. So the transitory crowd gets a little bit of a victory, maybe a little bit too little too late, as we're about to get slammed by this energy price inflation story in March. But for now, that some of these disinflationary things are playing out. So I think data dependent is certainly the name of the game for the Fed. But until then, as long as they seem like they're willing to continue hiking, that seems like what the markets are willing to price in.
Brian, Julie, Jim, sticking with us into the opening bout. We'll carry on building on this. Headline from Vladimir Putin, the Russian president, just moments ago. Russia to hold gas contracts if buyers don't pay in rubles. That was not the impression that Mario Draghi had getting off a call with Vladimir Putin earlier today and offering us his thoughts on the situation. We'll come back to Maria Tadeo a little bit later this hour on that. Dollar ruble's not much of a market at the moment for many people in this market. I know you've all told me so many times. Euro dollar, though, does roll over by 0.8% now. Session lows 110.72. Coming up in the morning calls and later, closing out a tough Q1. Stocks heading for their first quarterly decline in 2 years. That's next. 4 minutes away from the opening bell. Let's get you some morning calls. Barclays downgrading AMD to equal weight, seeing cyclical headwinds across end markets. Citi upgrading 5 below to buy, pointing to the stock's attractive valuation. And finally, Guggenheim raising its Roku price target to 145, highlighting strengthening data in European markets. Coming up on the programme, wrapping up an ugly Q1. From New York, this is Bloomberg. "24 seconds away from the opening bell in New York this morning. Good morning. Wrapping up Q1 and the month of March. Q1 messy, but the month of March has been a big month of gains for the S&P 500, up more than 5% coming into the final trading day of the quarter and the month. Futures down about 0.1% on the S&P. Let's the opening bell, switch on the board and get to the bond market. What a move we've seen across the Treasury curve. On 10s right now, yields lower by a couple of basis points. On the session, your 10-year 233. On the month, your 2-year up by more than 80 basis points in a single month. And here we are with an equity market doing okay. We are about 10 seconds into this session and your S&P 500 is lower by 0.1%. Energy underperforms, down 0.4% off the back of the move low we're seeing in crude. Let's get you some movers. Here's Abby.
John, let's stick with that energy story because the energy movers really do stand out on the back of that move lower in crude that you were just talking about. ExxonMobil, big oil down sharply, although off of its lows right now, down about almost 1%. Occidental Petroleum, though, down a little bit more, down 1.5%, with yields in that big surprising move that you're talking about. Morgan Stanley, some of the banks a little bit softer, not in a big way, down about 0.6%. And yields down usually is good for tech, and we do have some tech names higher, but AMD, as you were talking about earlier, a downgrade. Micron seems to be down in sympathy with that to some degree. Plus, yesterday that stock was up on strong earnings. So across the board, a little bit of weakness here on the open, John.
Abby, thank you. It's a confusing time for energy. So this is what we know so far. A little bit later, we'll hear from the President of the United States on energy and what he's going to do about gas prices. This is what the team here at Bloomberg learned down in Washington, D.C., that they're considering the potential of a massive reserve release. Could be 1 million a day, anything up to 180 million barrels overall. Look out for that. Could be announced as soon as today. In Europe, there's this strange spat emerging between the Russians and the Europeans over gas supply and what currency to secure that gas supply in. Vladimir Putin has said this morning. Buyers of Russian gas should open accounts in Russian banks. New rules for gas payments will be valid from April 1st. Russia pledging to continue to supply gas at set volumes and prices, but ultimately they want those volumes to be paid for in rubles. And not in euros, not in dollars, but in rubles. How can that take place in the current sanctions regime, and will the Europeans go along? And seemingly at the moment, every single European leader has pushed back against this suggestion so far. I'm going to head to Europe a little bit later in about 15 minutes' time and catch up with a colleague of ours to run through the details here. Germany on the wires as well, saying the following. They say gas supplies are stable for now. They will introduce major solar and wind projects soon. The latest sanctions package is not the final one. That's the latest line from Germany. So there you are. The spat continues. As for this market, the final trading day for Q1. Stocks heading for their biggest quarterly decline in 2 years. I want to get to Taylor Riggs for a little bit more. Hey, Taylor.
You know, John, I think my theme for the quarter is it is all about perspective. Now, on one hand, you could say, look, we're looking at one of the biggest quarterly drops that we've had since March of 2020 on the S&P. But look how far that we've actually come back from some of the bottoms. Remember, we peaked on January 3rd. You were down in correction territory as much as 13-14%. Off some of those recent record highs, but you had actually big rebound in March. So we are only closing down 3.5% for the year. A lot of people are actually going to call that a win, given how far we have come back from some of the lows. Really, though, John, as you know, this story is all about the bond market. Change up the board and you can see it is the biggest quarterly increase in basis points and yields on the 2-year since 1984, depending on how today shakes out. Looking at one of the biggest increases this quarter on the 10-year yield going back in more than a decade. So really, it's all about that rate of change. And it has really been a bond story. Quickly, we'll look at, though, some of the pandemic winners and losers. A lot of the winners that we had since March 2020, those, as we think about the rotation within the S&P, some of those stocks are actually some of the big underperformers. It's Vroom, it's Fastly, and then, of course, Pinterest as well. Also another one, Zoom Video, off anywhere 20 to 30% as well for the quarter.
Taylor, what did you make of Restoration Hardware and that call that everybody's been talking about? What did you make of it?
You know, I think really interesting. We had a good point yesterday where they clearly have a certain customer, right, John? They are speaking to a certain audience. But if you think about a company and a CEO on that call, using that macro environment to talk a lot about the supply chains, to talk about the inflation, you do wonder if it is that idiosyncratic risk or if those macro comments that he made actually do apply across the board. We're mindful there is a clear customer, though, when it comes to RH.
Taylor, thank you. If you're not familiar with this story, for our audience outside of America, a furniture store which fancies themselves as a lifestyle brand as well. You can go there and hang around a restaurant in New York City if that's what takes your fancy and you're bored on the weekend. You'd have to be very bored, in my opinion anyway. Anyway, they came out yesterday on a call and basically said that things have decelerated materially. To Taylor's point, is it RH specific or is it about something broader? Take a listen to what David Kostin of Goldman had to say on earnings.
There's going to be a significant number of negative earnings surprises. In fact, you probably get a large number of pre-announcements in the coming weeks just before the earnings season. You have these events that have really impeded a lot of sales for a lot of companies. And I think managements have been reluctant to give guidance.
Back with us, Jim Keenan, Brian Nick, Julie Biel. Jim, let's start with you. The outlook for earnings. Goldman's saying expect some negative surprises. Would you go with that?
I would, but I'd say in aggregate, I think it's going to be fairly balanced. I mean, at the end of the day, you know, nominal growth is still going to be good. We are downgrading real growth, but with that inflationary pressures, earnings are going to be tied towards that. And I think you'll see a huge bifurcation between what industries are benefiting from that and what industries are going to get squeezed because of labor costs, input costs, or, you know, even supply disruptions, in which case, as David pointed out, they can't actually deliver the goods. So I think there's going to be a pretty bifurcated story between what you're looking at. But in aggregate, I think the earnings story over the course of the year is actually going to be pretty strong. I think margins ultimately come in a bit, but top line holds as you see a consumer in a decent space, and as the labor market continues to be good, I think the consumer in aggregate holds even if it slows. And at the same time, I think business investment will continue just because of the need for resiliency, right? I mean, at the end of the day, we're looking at all these supply chain constraints. Businesses and governments are going to have to invest in more of the infrastructure on some of these secular trends. And so I think that the earnings story is pretty good. And I would say, valuations have tightened up to that story. I remain to think that that's going to be volatile. And so we still like the credit markets because of that, and certainly more on the front end where you reduce some of the interest rate vol.
Julie, from an equity perspective, do you share that more constructive view on earnings?
I think it's going to be much more of a mixed bag. I think there are definitely going to be companies that benefit or can manage through supply chains, those that have differentiated business models that can pass on pricing. But I think ones that are, just kind of your average commodity business that doesn't really have a lot of pricing power, those are really going to struggle. And, I think we all can agree that margins are pretty close to peak. And seeing margin degradation is not typically very good for valuations or earnings. We also have concerns about what's going to happen with buybacks in terms of the new regulations. So I think there's a little bit of a concern of what earnings growth really can look like. And so for us, trying to find businesses that have earnings durability and resilience is the way to position yourself going forward.
Julie, where are you finding them? Because I think your point is an important one and will resonate with a lot of people. How can you make a forecast in this environment? Jim's speaking to that, speaks to the volatility of the next year or so. You just shy away from it, saying don't even try and make one. Where are you focused?
I think where we're focused is try to find businesses that have enough of an earnings track record that you can see how they behave in an inflationary environment or even in an environment where there's a slowdown in their own industry. If you look at a company, Jack Henry, which serves financial institutions, you look at that business through the financial crisis and it looks like it didn't even happen. That's because it's so central to the operating of any kind of financial institution for which it serves. So that's the type of business that we really like.
Brian, where'd you come down on this?
I think the important story in the first quarter that you wouldn't see by looking at the data is that the economy has generally been quite good. I mean, 6 months ago or 4 months ago, we were talking about Omicron and the consumers weren't going to be able to spend them. That's not what we're seeing. The strongest part of GDP growth in the first quarter will be sales, people buying stuff and businesses buying stuff. And that should be good for revenues. So the question is going to be on the cost side. We did have in the first 2 months of the year, 1.6 million people enter or re-enter the labor force. That's going to take wage pressures off just a little bit. They're still running really high. Aggregate wage growth has been close to 10% over the last 6 months. So that could be a potential concern for profit margins. But where this comes out in terms of where to invest, I still think larger companies more oriented toward growth are going to be the preferred market here as we kind of normalize back down past the reopening phenomenon. And also as companies who probably have an ability to meet those rising wage pressures with offsetting costs elsewhere, have a little bit more room to keep profit margins wide. Small businesses are the ones that are really struggling at this point with inflation.
Brian, since everyone is reluctant to come out with a crystal ball at the moment, can we try that now? Where do you see the economy at the end of this year? I mean, I'm just looking at things play out. Consumer confidence, rock bottom, right? Gas prices, sky high. I'm seeing inflation start to bite for a lot of people. At some point, you'd have to believe that hits activity. You were talking about the top line. I'm wondering when people stop buying, when discretionary spend really gets hit around. And this is what David Costin of Goldman's getting at. He's saying that the earnings risk is around the consumer. Staples, discretionary spending, those kind of things. Do you not share that?
I'm not that alarmed by it. I think the savings rate is still 6.3% as of the end of February. I think energy is going to eat into that. But there's also a lot of accumulated savings on the sideline. It isn't captured by that monthly rate. So we have about $2 trillion of extra cash on hand. It's not dispersed equally in the economy. I think the concern this year is that a lot of the growth last year came from people in that bottom 20 to 40% of income earners who spent a lot more money last year than they normally do because of the stimulus, and that money is gone. So we're not going to grow at 5.5% this year, but we could still grow at 2.5% this year on average after a shaky first quarter that I think is going to get dented by inventory decumulation. But in general, I still think we're going to be at or above trend throughout the balance of this year in terms of the real GDP growth. And we end up somewhere in the 2.5% to 3.5% range.
Judy, the eyes in the control room telling me that your head is shaking. I'm trying to work out if it's going up and down or side to side. Which one is it?
I like to be mysterious, No, I think that's a really good point. I think the consumer is such a central driver to the U.S. economy, and it is starting to come under material pressure. And you're seeing that in terms of what's being bought, right? We are seeing fewer durable goods, right? Because more of the budget, particularly of your lower income consumer, is just going to groceries and gas. So I think that has a material impact on the rest of the economy and earnings writ large. And, if you think about what the Fed is doing, right, what's been driving so much of the economy has been, purchases of homes and cars. And I think having an a rising rate environment is hopefully going to slow down demand there. But I'm not sure that you'll see a pickup in durable goods or in the rest of the economy. So I think there's downside risk in terms of the consumer's ability to continue to spend.
Home Depot already having a very ugly start to this year. Home Depot on the quarter down around about 25% so far year to date. Judy, thank you, alongside Rudnick and Jim Keenan as well. Coming up, OPEC and its allies staying the course.
We have one objective only, which is trying to maintain the supply to the market and ensure that that supply is affordable.
I asked the gentleman, the minister from UAE, why the last meeting lasted 13 minutes. The team reporting the following this morning. OPEC Plus hurried through its last meeting in just 13 minutes without discussing the issue that was dominating global commodity markets. It beat that record by a minute at today's talks. That conversation still ahead. If you're trying to follow the gas story out of Europe at the moment, it's difficult. Breaking news in the last 15 minutes. This line from Vladimir Putin of Russia. To buy Russian gas, they need to open ruble accounts in Russian banks. It is from those accounts that gas will be paid for starting April 1st. If such payments aren't made, we will consider this a failure by the client to comply with obligations. I want to catch up with a good friend of mine and ours, Guy Johnson, out of London. Guy, make sense of this. Can you compare and reconcile the comments from Vladimir Putin with what we hear from Chancellor Scholz and Prime Minister Mario Draghi about what they said Putin told them with what Putin is saying this morning?
So I do actually think, John, that they could fit together. And here's how. Basically, you, as a gas buyer, open an account in Russia with Gazprom Bank. You then transfer foreign currency into that account. Gazprom Bank then buys rubles with that money and then buys the gas. It is unclear at this point, I admit, but that certainly fits reasonably well with what we got from Draghi. So I think this is a way of both sides kind of getting what they want. But I still think, judging from what I've read, but I think it is, as you say, unbelievably confusing, and the message is unbelievably mixed. But the text basically says foreign buyers transfer foreign currency to a special foreign currency account, and then the bank buys rubles on the exchange, which is then used to buy gas. Does that explain it? I'm not entirely sure, but that's kind of where I am.
That was better than my effort, guys, so thank you. I guess to stick to the reporting, because if I comment, I'll be deep into the realm of speculation as to what's going to happen here. From what we've heard from the Germans, are they satisfied with the supply, the volume of gas they're currently receiving?
At the moment, I think contracts are being satisfied, but whether or not that is going to be enough to deliver what we need going forward is an open question. John, at this point, when you think about gas in Europe, you need to think about not about what's happening now, but what is going to happen next winter. At the moment, storage is, let's call it circa 25% full. The recent weather has been quite warm, and actually we're back into where we would roughly normally be at this stage in the year. So the tanks aren't that depleted. In fact, they're being refilled right now because the weather recently has been so warm. So we're back to we're not too far away from where we would normally be. Now, the question going forward is, can Europe buy enough gas to get the tanks to where the EU would like them to be? I think it's this year 80% full, next year it's 90% full. But that's kind of the trajectory we're on for at the moment. And in order to make that happen, European prices need to remain above Asian prices, because ultimately the swing factor here is not Russian gas, but global LNG, which is going to fill the gap.
Guy, just a final question from me. This side of the Atlantic, we'll be looking ahead to the President of the United States later. There's this conversation about a monster reserve release. How is this playing out in Europe? As most people assume that there would be a greater effort from this White House to get in touch with Riyadh. Can we just assume that that outreach has failed? And can anyone bridge the gap between Washington and Riyadh? And can that be done out of Europe?
I'm not sure it can be done out of Europe. I think that's going to be something that is going to be tricky to achieve. Look at what happened when Boris Johnson went to the Gulf, didn't come back with any extra barrels of oil, which I thought was significant. And you think about what is happening here as well with the Iran story. Basically, 1 million barrels a day is kind of where Iran would be. So you take Iran out, you put this oil in. But ultimately, John, this is probably going to widen the spread between TI and Brent. It is going to have more an effect in the United States. But long term, as somebody put it, we're going to talk to the Trafigura chief economist a little bit later on. This is a bonus rather than a pay rise, and this may discourage shale from shipping extra barrels or producing extra barrels. And the other factor as well here that you've got to bear in mind is that refineries still haven't got the barrels from the previous SPR release. So it's going to take a while for this to come through.
This has been messy for sure. Guy, looking forward to the programme. Starts in about 10 minutes' time. Thank you, buddy. Out of London, Guy Johnson there. 1:30 p.m. this afternoon. Joe Matthew from DC joins us now for more. Joe, this is going to be a big focus for you. What do we expect to hear from this president?
We're going to have this conversation in dollars, Jonathan. You're right. 1:30 p.m. We'll see how close we come to this being on time. Washington time today. As you just referred to, this is going to be a major announcement of a release of oil from our strategic petroleum reserve, but not like the single action that we've seen historically when the president makes a move like this. This is going to be a rolling release over the course of many months, 1 million barrels per month. Sources telling Bloomberg, we don't know exactly how long that will last, but could be a total release, Jonathan, of 180 million barrels. So this is a pretty big deal. The president's done this twice now, tapping the reserve. 50 million barrels back in November, followed by another 30 million in March following the invasion of Ukraine. And as we can see here in the numbers, neither went very far to impact prices. AAA has the national average at $4.24. This all comes down to what you were just talking about, Jonathan. OPEC not budging, despite a lot of effort from this White House to convince them to increase production. So here we are today with an administration trying to do what it can to impact prices.
Joe, the pushback we've had, and we've had a lot on the programme earlier this morning with Tom and Lisa, and again today, just sceptical minds. Why will this make a difference?
It might
Does anyone think it will?
It might not. We're talking about, there are two different conversations here. Bloomberg, we want to know what this means for prices, what it means for supplies, the global economy. Here in Washington, this is about politics. This is about perception, a White House that wants to be seen doing whatever it can to lower prices for Americans. This is going to be an inflation conversation more than an oil market conversation when the president speaks a little bit later today. Even if it doesn't work, Jonathan, they can say, walking up on the midterms, that we did what we could with the tools we had.
Hey, Joe, we'll see. The market will speak for itself, I'm sure. Joe Matthew, looking forward to the show a little bit later. Joe Matthew, sound on. Bloomberg Radio, 5 p.m. Eastern Time, Monday to Friday. And looking forward to the coverage around this from David Weston as well, going into that address by the president at 1:30 Eastern Time. Crude is lower by 4%. Brent at 108. WTI down 3% at 104. Let's get you some sector price action with Abby.
Well, John, very interesting given the fact that we have that weakness for oil itself. The energy sector is the top sector at this point, right now up about 0.6%, followed by the dividend-rich sensitive sectors, real estate and utilities doing well as rates are down. And then interesting, tech and communication services, the worst, down about 0.6%. On the year, it's all about energy, especially for the domestic producers. This is an incredible chart. The index of domestic producers on the year, John, up 52%.
Abby, thank you. Up next, your trading diary. Pushing ahead to Payrolls Friday. It's just around the corner. From New York, this is Bloomberg. We have the response from Chancellor Scholz. He says the following. Breaking news. Companies must be allowed to pay for gas in euros. That's the response from Germany. Chancellor Scholz saying companies must be allowed to pay for gas in euros. Vladimir Putin, a Russian president, saying this. To buy Russian gas, they need to open ruble accounts in Russian banks. It's from those accounts that gas will be paid for starting from April 1st. If such payments are not made, we will consider this a failure by the client to comply with its obligations. How do you square this circle right now? Guy Johnson's going to do a decent effort on that in about 5 minutes' time. Look out for that. I want to run through your trading diary just briefly. You'll hear from the president at 1:30 Eastern time on energy prices. Friday, the main event. It's payrolls Friday, plus Fed speak, continuing with Chicago Fed President Charles Evans. And looking ahead to next week, oil executives heading to Capitol Hill on Wednesday. Then we'll get the Fed's latest meeting minutes. From New York City, thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.